At its core, gamma exposure-based trading revolves around understanding and exploiting the option market's gamma risk. Gamma measures the sensitivity of an option contract's delta to changes in the underlying stock price. Traders that utilize gamma exposure aim to capitalize on this sensitivity to price movements, particularly during periods of extreme volatility expansion and extreme volatility compression. Unlike traditional trading strategies that rely solely on directional movements or technical indicators, gamma exposure-based trading focuses on a combination of market positioning and implied volatility itself as a primary driver of profits. This data-driven approach stands in stark contrast to most short-term strategies that many traders typically use. By strategically positioning option contracts, a GEX-based methodology can profit from rapid price swings based on where option dealers and other big players in the market are positioning themselves. Check out this example on Netflix. You can see where market participants were concentrated the heaviest according to GEX, which was at the 600 strike over here. This was actually 8% higher than where price was currently trading at the time. You can see price was trading around $555. So using this data, we could assess a number of different option strategies that both target a potential move towards 600 and also fit within the overall risk-reward profile of an entire options portfolio. The market can and often does change its mind pretty regularly. Unfortunately, gamma exposure is not a perfect crystal ball. It's really a reflection of market interest and price sensitivity. However, we've found that using GEX data combined with an asymmetric risk-reward portfolio methodology can yield successful results. In the case of our Netflix example, price did eventually go on to tag that 600 level 2 weeks later. One of the great things about gamma exposure-based trading lies in its ability to thrive in both volatile market conditions and low vol environments. The key advantage of this strategy is the ability to determine whether or not the market is positioned for volatility expansion or volatility compression. And of course, this is a key factor in option pricing and movement. By analyzing the total gamma exposure, for example, for the SPY, SPX, QQQ, etc., we can also determine if the market overall is leaning bullish, bearish, or neutral, especially on a short-term basis. Because GEX is based on the options market, using this data for research allows us to focus on particular strike prices at specific points in time. Here's an analysis on GLD showing gamma exposure concentrated at the 195 and 200 strikes in the March 15th expiration. By combining this data with various option structures like credit and debit spreads, iron condors, double diagonals, etc., we can tailor option positions to achieve an asymmetric risk-reward profile in our portfolio. And essentially, we can target these strike prices at specific expiration dates that have the highest gamma exposure concentrations. Let's take a look at another example. Here we see the SPY having positive gamma exposure, and think of positive gamma exposure as kind of like a buy the dip market environment. At the same time, let's just say we notice that Tesla has negative gamma exposure. Negative gamma exposure is what we often see associated with higher potential volatility. In this example, we noticed Tesla had been struggling and had a large negative gamma exposure concentration between the 160 and 175 strikes, with very little positive GEX showing at higher strike prices. Market participants appeared to believe that Tesla would remain weak even in the face of market strength. Based on this data, if our portfolio overall, let's say, was positioned bullishly because we saw that the SPY had large positive gamma exposure, we may actually decide to add a short or neutrally biased option strategy in Tesla into our portfolio mix. By structuring a low-cost option trade in Tesla, we've given our portfolio the potential to capture a very specific outcome based on the options market in Tesla itself, even while the rest of our portfolio may be bullishly positioned. So in our experience, analyzing GEX data on individual stocks and incorporating specific option strategies into our portfolio mix allows our portfolio to have greater resilience against unexpected market movements and enhances the overall robustness of the trading strategy. So here's a few key principles of gamma exposure-based trading that we follow. Number one, Option selection. We found that constructing a portfolio with a variety of different option strategies is really paramount to success in GEX-based trading. A combination of option strategies such as credit spreads, debit spreads, diagonals, butterflies, etc. that target various GEX concentrations across ETFs and individual stocks can have the potential to enhance overall results. This methodology has the added benefit of potential profits in a wide variety of market outcomes, since not all stocks move in unison, especially in the short term. Number 2, risk management. Despite its potential for high returns, GEX-based trading carries inherent risks. Traders have to implement robust risk management strategies in order to protect against adverse market movements and mitigate potential losses. So we'll often hedge our portfolio with the aim of simultaneously accounting for both upside, downside, and/or range-bound market outcomes on a short-term basis. Oftentimes those hedges will lose money, but in the overall grand scheme of things, this risk management component allows us to help mitigate large potential losses over the long term. Number 3, dynamic portfolio hedging. Because GEX data changes in real time, continuous monitoring and adjustment of positions are essential in GEX-based trading. Our gamma exposure dashboard actually calculates GEX on a real-time basis across every ticker that we follow. And so this helps us be prepared to dynamically adjust our positions as GEX evolves in order to account for changes in the gamma exposure concentrations at specific targets and strike prices that we're monitoring. Number 4, market awareness. Successful GEX-based traders monitor total gamma levels in the major indices and index ETFs in order to understand if overall market positioning is shifting. By monitoring GEX in real time, we can identify potential opportunities and navigate market fluctuations with more confidence. By the way, if you're interested in learning more about our GEX-based methodology, consider becoming a member at geeksoffinance.com. Our members receive access to our live GEX dashboard, our 5-hour GEX-focused education course, as well as our community Discord. We'd love to have you join us, so definitely check that out when you get a chance. And if you're new to gamma exposure and the different methodology that comprise a GEX-based strategy, check out our other videos here on YouTube. We've got a whole playlist where we dive into the nitty-gritty of GEX-based trading. I'll put a link in the description below. Thanks so much everybody for watching. We'll see you guys in the next video.